In this video, we're going to be performing a deep dive on Southern Company's dividend safety. To begin, let's talk about Southern Company's business model. Southern Company is an electric utility that, through its operating subsidiaries, supplies electricity to 4.6 million customers in Georgia, Alabama, Florida, and Mississippi. The company employs more than 30,000 people and trades with a current market capitalization of $45 billion. Southern Company is a well-known dividend stock because of its compelling track record of dividend growth. With 16 years of consecutive dividend increases, Southern Company is a member of the Dividend Achievers Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, Southern Company's high dividend yield has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Southern Company's dividend safety in the context of the company's current earnings. When Southern Company announced its third quarter financial results on November 7th, the company announced that it generated earnings per share of $1.14 in the 3-month reporting period. For context, Southern Company currently pays a quarterly dividend of 60 cents per share, which implies a payout ratio of 53% in the most recent reporting period. Looking out over a longer time horizon, our conclusion is the same. Southern Company generated $2.83 of earnings per share through the first 9 months of fiscal 2018 and paid $1.80 in common share dividends during the same time period, for a payout ratio of 64%. Using earnings, Southern Company's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Southern Company's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Southern Company generated $5.6 billion of cash from operating activities and spent $3 billion on capital expenditures for free cash flow of $2.6 billion. The company distributed $1.8 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 69%. Using free cash flow, our conclusion is the same as when we use earnings per share to measure Southern Company's dividend safety. The company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Southern Company's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Southern Company's performance during that time period is shown here. Southern Company's earnings per share declined by just 1% during the last economic contraction. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Southern Company's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Southern Company generated $458 million of interest expense and had $16 billion of total debt for a weighted average interest rate of 3.8%. The following image shows how changes to Southern Company's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Southern Company's weighted average interest rate would need to rise to about the 9% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that Southern Company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Southern Company's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.